Hi. One problem you might have is that you perhaps personally own shares in a company that in turn owns property. Now this seems all very well and good, but unfortunately when you die, some hefty taxes kick in. The first one is estate duty. Now estate duty is at 20% and it's taxed on your wealth. Your wealth in this case will be the shares in the company, which started at value 0, but now they're probably worth 2, 3, 4 million. So your estate's going to pay 20% on the value of those shares. But that's not the end of the story. Unfortunately, you're deemed to have sold your assets to your deceased estate at the moment of death. And in this case, what are your assets? The shares in the company. And you're deemed to have sold at market value. It was worth 0 when you bought, the company was. And it's probably now worth, I don't know, 4, 5, 6 million, depending on the increase in the value of the property. You're deemed to have sold that and made a capital gain of 4, 5, 6 million. And capital gains tax is applied on that deemed sale at 13 2/3%. That means that on death, you're going to be taxed 20% estate duty and 13 2/3% on the value of those shares. And that's a third of your wealth already gone in tax. Problem is, it's got to go in cash. Where's the cash coming from? So your executor's going to have to say, well, I'm going to have to sell the property to pay the taxes. But of course, it's not the estate that owns the property, it's the company that owns the property. So the company is now going to sell the property, and guess what? There's CGT to pay on the gain that the company makes in the value of the property. And CGT in the property in a company is 18.65%. So now you're in for 33 2/3%, and the company is now going to pay 18.65% capital gains tax on exactly the same value. So if my mental arithmetic serves me well, that must add up already to about what, 52%? But that's not the only problem. The problem is that the company now sells the property, collects the money, repays the bond, or whatever loan it took out to buy the property in the first place, and pays the CGT and sits with a cash balance in the bank, in the company's bank. But of course, it's no good there, is it? We want it up in the estate to pay the taxes. And how are we going to get it there? I'm afraid the only way is for the company to pay a dividend to its shareholder. The shareholder is the deceased estate. And guess what? There's a thing called dividends withholding tax. 15% of that dividend is going to go in tax. Now, of course, the dividend will not be the full sale price of the property because we've already paid CGT on that. So the effective tax, dividends tax, is probably going to amount to maybe, what, I don't know, 10, 12%. So now we've got the 50-odd 2% plus the 12-odd %. We are now in for something like 64% of your wealth going in tax just because you died with this structure. Isn't that bad news? Fortunately, it can sometimes be rectified. And when I say sometimes, it can always be rectified, but the problem is that in that rectification, there are often taxes involved. Sometimes the taxes are so trivial that it's worth doing. Sometimes they're so horrendous that you actually just have to say, well, I've got the problem, I made a mistake, I won't make that mistake again. Give it some thought, and especially if you're an attorney, think of any of your clients who are in this position, because really, if you're going to serve them well, you need to bring this to their attention, and you need to maybe try and sort it out. Now, I'm available to do that. I know about these things. I'd be very happy to discuss it with you or with your client, depending on whether you're an individual or whether you're an attorney. All it takes is an appointment with me, which is very easy to make online, and I look forward to seeing you, and we can maybe sort this little problem out. Well, not such a little problem actually, it's quite a big one. Cheers.